Let's be real. The cost of everything in Canada is still a huge stress, and it feels like your bank account is getting squeezed from all sides. If you're stressed about money and feeling like you've lost control, you're not just imagining it. A recent survey found that more than half of Canadians are struggling to keep up with their financial commitments. And while the talk of a recession might seem like a distant threat thanks to some news articles that I talked about in my last video with a bit of an angry tone, I might add, for many people, the economic slowdown, the contractions earlier this year, it all makes us feel kind of like we're already in a recession. And to be honest with you, I think we already are in everything but the definition of the term recession. Now, the one thing I want you to remember is you're not powerless. It's easy to feel defeated when you hear about interest rates and inflation, but I promise you, you are powerful, and there are powerful moves you can make. And in this video, I'm gonna walk you through 5 honest, no fluff steps that you can take right now to help try and fix your budget, to slash some financial stress, and to start taking back control of your money. I'm a mortgage broker here in BC, and I talk to people every single day who are feeling the exact same pressures as you. My goal is to give you the same actionable advice that I would give them. So let's dive into it. All right, first things first, budgeting. I know, the word budget makes most people want to run to the hills. It sounds restrictive, boring, and like a ton of work, but I want you to reframe that. A budget isn't a financial diet designed to make you miserable, it's a roadmap. It's you telling your money where it goes instead of wondering where it went. Even though the main inflation rate has cooled down to about 2.2%, the prices of essentials like food and shelter are still climbing. So you can't afford to be flying blind. So where do you start with this? You start by tracking everything. For 1 month, you should try and act as a detective on your own spending. Use an app, a spreadsheet, a simple notebook. I really don't care what tool you use as long as you use it. And if you like one, we have one on our website. It's free. You don't have to give me your email or anything. You just download it and use it. And I hope it helps. At the end of the month, by following this, you're going to have a brutally honest picture of where your money is going. And this is where the magic happens. You'll see patterns. You'll see that $7 coffee adding up to $100 a month. I know, the coffee a day theory. You'll find 3 different streaming services that maybe you forgot you were even paying for. I know I've found one in the past. This isn't about judging yourself. It's about finding the leaks in your financial boat. These are the non-essential expenses and the subscriptions that quietly drain your cash flow every single month. Once you see it all laid out, you can start making conscious decisions. Is this daily latte worth more to you than your goal of saving for a down payment or a vacation? Is the unused gym membership more important than getting out of debt? Not saying you shouldn't exercise, just maybe don't pay for a gym membership. Go for a run, go in your yard, pick up something heavy and put it back down. I don't know, I'm not a gym guy, but budgeting is a simple act of aligning your spending with what you truly value. It's not about restrictions, it's about empowerment. It's the foundational step to taking back control. And in this economic climate, it's not necessarily optional. I see it as being essential. Once you've gone through your budget and trimmed the fat, shall we call it, you're going to have some extra cash flow, or should hopefully have some extra cash flow at the end of the month. It might be $50, it might be $500. The temptation will be strong to see that extra money as fun money. Don't let this happen. This newfound cash has one critical and urgent mission: to destroy any high interest debt that you have. I want you to think of high interest debt like credit cards, payday loans, car loans, things like that, the same way you think about mold in a house. If you see a little spot and ignore it, it doesn't just stay there, it grows. It spreads behind the walls and gets into the structure of your house. Before you know it, what was a small problem is now a massive, expensive, and stressful disaster that's wrecking the integrity of your entire home. Debt works the exact same way. That small credit card balance that seems manageable because you're making an interest-only payment can quickly spiral out of control with interest rates of 20% or more. Let's be clear about numbers. As of the third quarter of 2025, the average Canadian was carrying credit card balances of around $4,652. If you're only making the minimum payment on that, you could be paying thousands of dollars in interest and be stuck with that debt for decades or more. With the household debt to income ratio in Canada sitting around 175%, meaning we generally owe $1.75 for every dollar of disposable income we earn, this is a national crisis playing out in our individual homes. So take every single dollar you freed up and throw it at your highest interest debt first. This is often called the debt avalanche method. List your debts from highest interest rate to the lowest and attack the one at the top with everything you've got while making minimum payments on the others. Once it's gone, take all of that money that you were paying on it and roll it into the next one. And chances are you freed up cash flow at this point too, because you don't have to pay that debt, right? Increasing cash flow, you see where it's going? This creates momentum. This is how you get rid of financial mold before it takes over your house. Killing that debt is the fastest way to improve your cash flow and build real financial resilience. By the way, if the idea of setting up a budget from scratch feels overwhelming, I've got your back. As mentioned, I've put together a simple free budgeting spreadsheet that does all the math for you. You can download it directly. There's no cost to it. You don't have to put your email in. It's free to use. I want you to have it. It's the same basic framework that I use with my clients to get a clear picture of their finances, and the one that I use for myself so that I understand my finances as well. I'm going to put the link down in the description below. Like I said, click it, download it, use it. It's free. I don't need to know any information, and I hope it helps. Now, let's get back into the video. If the last few years have taught us anything, it's that life is unpredictable. A global pandemic, supply chain meltdowns, rapid inflation, a trade war. Things can change, and they can change fast. That's why your third step after you've tackled the worst of your debt is to build a robust emergency fund. This is not your save for vacation fund. This is your life happens shield. This is the money that protects you when the car breaks down or the roof needs to be replaced or you face a sudden job loss. How much do you need? The classic advice is 3 to 6 months of essential living expenses. But in this economy, and something I've always recommended is aiming for 6 to 12 months. And I want to emphasize on the word essential. This isn't 6 months of your full income. Although if you can do that, I recommend it. It's 6 months of what you need to survive. Your mortgage, your rent, utilities, groceries, transportation, insurance, things like that. Go back into that budget you created in step 1 and add up all those costs for 1 whole month and multiply it by 6 to 12. That's your target. And as mentioned, if you can push that to being your full paycheck, by all means, do that. It's a good idea. I know what some of you are thinking. 6 months, I can barely get through this month. And I hear you. It sounds like a mountain, but you don't climb a mountain in one leap. You do it one step at a time. Start small. You can automate a transfer of $25 a week into your separate savings account. That's over $1,000 a year. Once high interest debt is paid off, redirect that entire payment straight into that emergency fund. The key is making it automatic and consistent. I'll use myself as an example here. Before I had my son, I sat down with my dad and I said, I don't think I'm financially ready to have a child. And I desperately wanted one. And what he said shocked me to my core. He said, you may or may not be, but it shouldn't hold you back. You will be amazed at what you can do and how you won't miss that money when it's allocated to those other things. I took that advice to heart, and now I have a 2-year-old and a happy household. And I can tell you, yes, my expenses have gone up between daycare, diapers, and everything in between, but I haven't noticed that money necessarily gone. Have we cut back on things? Absolutely. Have I noticed? No. It's amazing what you can do. You just have to put your mind to it. Now, a question I get commonly asked is, where should you keep this money? It needs to be safe and liquid, but not too accessible. You don't want it in your daily checkings account where you might accidentally spend it. A high interest savings account is a great option, and a tax-free savings account, or TFSA, can also be a fantastic place to park this money, as the money can grow tax-free and you can withdraw it anytime without penalty. Just make sure you're mindful of your contribution room on that TFSA. This fund is your single best defense against future debt. When an emergency strikes, you'll be dipping into that savings instead of dipping into high interest credit cards or lines of credit or your vacation fund or retirement savings. It's there for a reason. It's your shield. It works well. Now, this next point is for all those Canadian homeowners out there, and it's a big one. The stress around mortgages right now is immense. According to the Bank of Canada, about 60% of mortgages are coming up for renewal by the end of 2026. And a huge number of those are expected to come with higher payments. For those who locked in at historically low rates a few years ago, the payment shock can be significant and potentially increase by hundreds to thousands of dollars per month. It's completely normal to feel anxious about this, but you do have options. First, don't panic. Panicking is not a strategy. You want to be proactive. As a mortgage broker, this is what I help people navigate every single day. Your bank might present you with a standard renewal offer, but it's not your only choice. Here's a few things you need to explore. First, consider extending your amortization. It may be possible to stretch your remaining mortgage balance over a longer period. This will lower your monthly payments and ease the immediate pressure on your budget. It does have a trade-off since you're paying off your mortgage slower and you're going to pay more interest over the long term, but it can be vital and a lifeline to keep your payments manageable right now. And remember, your amortization, it's more of a guideline. It goes up, it goes down. You can do bi-weekly payments, all sorts of things to get yourself back on track. The main focus right now is what can I do? Am I comfortable? And can I make my payments? Second, talk to a mortgage professional about all of your options. This includes refinancing and restructuring your debt. Maybe it makes sense to roll high interest car loans or credit cards and balances into a new lower rate mortgage. This can simplify your payment and cut your overall interest costs and commonly increase your monthly cash flow. And you could be in a position where maybe you take that extra monthly cash flow, put it on your mortgage, pay your mortgage off faster. There's a lot of cool things we can do with that. I did a video on this. I'll make sure to put that in the description down below if you're interested. The most important thing is to not stick your head in the sand. Don't wait until a month before your renewal is up. Start the conversation around 4 to 6 months in advance. And please know that my door is always open. Even if you're not a current client, I am happy to offer a non-judgmental support and advice call to try and help you navigate this stuff. We can look at your specific situation and craft a strategy that works for you, even if you're not working with me. I just want to help. Taking action is the difference between just surviving and setting yourself up for long-term financial health. Now, this final step might seem like the most simple, but in many ways it's the most powerful, especially if you share your finances with a partner. You need to normalize talking about money. So much financial stress, especially in relationships, comes from a lack of communication. Assumptions get made, resentments get built, and problems are ignored until they become full-blown issues and crises. Here's my challenge to you. Schedule a 20-minute money meeting with your partner or family once per month. Put it in the calendar like you would any other important appointment, like the dentist or your financial planner or your tax person. This isn't a time to blame or criticize. Think of it as a business meeting for your household. During this meeting, you can review your budget from past months. What went well? Where were the challenges? Are you on track for your goals? You can talk about upcoming expenses for the next month, maybe a car repair bill, a birthday party, or a trip that you planned. This avoids surprises and allows you to plan for them together. This is your chance to check in, make sure you're both on the same page, rowing the same direction, and support each other through it. For couples, this single habit can be revolutionary. It builds transparency and teamwork. It transforms money from a source of conflict into a shared project. When you're both on the same team, you can navigate any financial storm, whether it's high interest rates, a job loss, or a surprise bill. This regular communication is the glue that holds your entire financial plan together. It cuts stress, prevents fights, and ultimately makes you stronger and more resilient as a team with your finances. I'm going to give you another example here, a personal one. I sit down with my wife and we do these meetings, and she's told me a couple of times I sound like the adults in Charlie Brown. But at the same time, if she wants to buy something one month and I say, no, we can't afford to buy it, she knows why. There's no surprises. And one of my goals is to actually include my son into these sort of conversations as well, with the goal that he can learn about financial resilience, he can learn about planning, budgeting, all these different things. Because to be bluntly honest, unfortunately, they don't teach this in our school system. And it's a failure, I believe. I think we should be learning about credit cards, lines of credit, mortgages, budgeting, investing, all these things in school, but we do not learn it. So by having your child sit with you, it can be really beneficial. That way, when they're in the toy store and they're having a meltdown because they can't get the dump truck, I mean, they're going to have their meltdown. They're worked up. They're not going to hear reason. But then later in the car, you can ask them, do you know why we couldn't get that toy? And maybe they look at you and say, because we can't afford it right now. Boom. Like, I get excited about this stuff. And the reason I like this is because, for one, you're teaching your child at a very early age budgeting, patience, the fact that you can't always have what you want, but you can try and get it later. And maybe you sit down and sit with them and say, you know, if we save this much per month, we can buy this at this point in time. And then you put it in the calendar and it's this big date and we're going to go get that dump truck. It's kind of fun. It's kind of cool. And it can be beneficial not just for you, but your children and that ongoing sort of family structure. So yeah, like I said, I get really excited about this stuff. Sorry, I'm rambling, but let's get to the conclusion of this video. There you have it. 5 honest, actionable things you can do right now to help adjust, fix, or repair your budget and take back control of your finances. 1, build a real honest budget to see where your money is actually going. 2, use that freed up cash flow to attack high interest debts like it's mold in your house. 3, build a 6 to 12 month emergency fund to shield yourself from life surprises. 4, if you have a mortgage, be proactive, explore all your renewal options. And 5, make talking about money a regular, normal part of your life so you can get as excited about it as I do, apparently. I know it feels like a lot, especially when you're already feeling the squeeze, but you can do this. The journey to financial control starts with single steps, and you've already taken a great one by watching this video. The goal isn't to be perfect, it's to be intentional. If you're feeling overwhelmed by your mortgage renewal, rising costs, or your overall debt, please reach out. This is what I do every single day. I can help you with a concrete strategy for your mortgage, your cash flow, and your debt. My contact information and a booking link will be in the description below. And as asked before, if you enjoyed this video, make sure to hit that like and subscribe button. And thank you so much for watching. If you have any advice or any ideas that I missed, put them in the comments below. My name's Myles Nowik of the Nowik Mortgage Team, powered by Andy Mortgage. We'll catch you on the next one.